In this section, we connect two worlds, classic AML and CFT in banking, and how those same principles apply in crypto. The technology looks new, but the core questions regulators ask about risk, controls, and accountability are very familiar. When you strip away acronyms and dense guidance, regulators mainly care about four outcomes. First, protect. Your platform must not become a highway for laundering, sanctions evasion, fraud, or terror finance. Second, know. You genuinely understand who your customers are and how they behave. Third, detect. You can spot and escalate suspicious activity. And finally, show. You can prove all of this with clear records, explanations, and reports. When people talk about an AML program, they really mean these four moving parts working together. First, policies and procedures. Your rule book for who does what, when, and how. Second, a risk assessment. Your honest, structured view of where your business can be abused. Third, controls. KYC, monitoring, sanction screening, and other tools that act on that risk picture. And finally, testing and training. Checking it actually works and keeping people competent. In traditional finance, compliance starts from named bank accounts. You know which legal person owns the account, and transactions move through closed systems like SWIFT and domestic ledgers via correspondent banks and processors. In crypto, the identifiers are wallet addresses, which stay pseudonymous until linked through KYC. Transactions move over public permanent blockchains, and the key gatekeepers become VASPs, exchanges, custodians, and DeFi protocols. KYC in crypto starts with everything you already know from banking. Verify identity, address, sanctions exposure, and source of funds. On top of that, you add wallet intelligence, which blockchain addresses belong to which verified customers, and how risky their past activity looks. The toughest area is self-custody wallets, where ownership is harder to prove and often requires extra checks, limits, or both. Monitoring in crypto operates in two connected worlds. At the center, you still watch your own books. Cash deposits, sudden volume spikes, classic structuring patterns. That's the off-chain view. Alongside that, you need an on-chain radar following where funds came from and where they go next across clusters and services. Because transfers are instant, effective programs blend both views, with rules tuned for near real-time reaction. Sanction screening for a VASP works in layers. First, screen people and companies. Does this customer appear on OFAC, UN, or EU lists before you let them trade? Next, screen blockchain addresses, blocking wallets tied to sanctioned parties or high-risk jurisdictions. Then assess more complex exposure, like flows passing through mixers or multiple hops, and escalate anything that sits too close to sanctioned activity. When you build a VASP risk assessment, think in four buckets that work together. Customer risk asks, who are you dealing with? Retail, institutions, PEPs, complex structures, unhosted wallets. Product risk asks, what can they do here? Spot trading only, or leverage, staking, privacy features. Geographic risk looks at where funds and users touch the world. And blockchain-specific risk focuses on mixers, darknet flows, risky DeFi, and other illicit links. Exchange layering is all about speed and hop count. Criminals break funds into smaller chunks, move them through several exchanges, flip tokens, then cash out to fresh addresses before anyone reacts. NovaX's job is to spot the pattern, not just a single transfer. Sudden bursts of deposits, rapid conversions, and exchange-to-exchange flows. Effective controls pause those exits, trigger deeper investigation, and, when needed, involve other VASPs and law enforcement. Mixers and tumblers pool hacked or illicit funds, then send them out through long-peeling chains of small transactions. The goal is to break the trace from crime to cash out. For a VASP, any direct or close proximity link to a known mixer or strange fan-out and fan-in patterns is a red flag. Strong controls detect these clusters early, pause activity, apply enhanced due diligence, and, when needed, file reports. Darknet markets are classic examples of why blockchain transparency matters. A customer might receive multiple payments from darknet-linked wallets, then quietly cash out to fiat or stablecoins in small, regular amounts. Analytics tools can attribute those source addresses. label them as darknet connected, and push a high-risk score. Your response should be structured. Pause the account, review activity, request explanations, possibly exit the relationship, and, when appropriate, file a report. Ransomware flows often start with a single threat actor address receiving a big payout, then quickly moving funds through several hops to exchanges or mixers. Your first clue is the risk signal, a sudden, high-value deposit linked to known ransomware infrastructure. Robust programs plug threat intelligence feeds into monitoring and react fast. Escalate, freeze funds where possible, document every step, and coordinate with law enforcement and other VASPs. Privacy coins and stealth addresses are designed to break the audit trail. Funds leave the visible, mainstream ecosystem, disappear into a dark zone, then re-emerge looking clean. For NovaX or Finbridge, the key is not decrypting every hop, but spotting risky behavior. Large privacy coin volumes, circular flows, or constant exchange to exchange movement. The response is targeted. Enhanced KYC, tighter limits, specific market restrictions, and closer monitoring of those re-entry points. Think of an effective VASP AML program as an engine with three tightly linked gears. First, foundation. Clear policies, a risk assessment, and trained people set the rules of engagement. Second, technology. Analytics and blockchain data help you see patterns humans would miss. Third, human judgment. Analysts and MLROs make contextual calls that tools can't. When those gears stay aligned, you prevent, detect, and report abuse, while still allowing legitimate innovation to thrive.